Alright, hello everyone, and welcome to the third part of our exam 3 review, where we're going to be talking about Chapter 11 and bonds. So we're going to be going through some multiple choice questions. This chapter is mostly conceptual stuff. So the first problem I want us to take a look at is this one. And a reminder, even though it's multiple choice, still take a swing at it before I go over it. So, which of the following scenarios indicates that a bond payable would be issued at a discount? So, the key to these questions is you're obviously going to be comparing the stated interest rate and the market interest rate. So, the market interest rate is going to be the interest rate that we would get if we probably went to like another firm out there to like purchase a bond and to pay interest on it. So like the other places are going to be like, all right, you're going to pay us 8% interest. Whereas the stated interest rate is going to be stated by this company that we're working with or we have a bond indenture with. And they're going to be saying, okay, we know you can get 8% out there, but hey, to buy our bond, we'll only make you pay 5% interest. So since the stated interest rate, since they're kind of giving us a deal, right? So we don't have to pay as much interest as we would in the market. So the stated rate is lower than the market rate. So therefore the answer is C, and it's a discount. Now, if the question asked would be issued at a premium, then it would be this one, because we could go get 3% interest rate somewhere else, but we're going to take this 5%. So that's that question. This video might go pretty quick. Alright, so Danner Inc. issued $500,000 of 10% stated interest rate bonds on January 1st, 2018. The market rate was 12%. The selling price, cash received upon issuance of these bonds was... So let's break down this question into some parts really quickly. So this $500,000 is going to be the face value. And this 10%, even though it doesn't say like an effective rate, it's the effective rate. This is the rate that's going to be in the bond indenture, or the rate that we agreed upon with Danner Inc. And the market rate. So we could pay 12% interest somewhere else, but Danner Inc.'s only letting us, or saying, hey, you only have to pay 10% interest rate. So that's actually going to make the amount that we, or the amount that Danner Inc. receives upon the issuance less than 500,000, because when you like value actually like the cash received upon bonds, you take into account like the interest rate and the time value of money. So when they're not getting a good interest rate as the market, it's going to be, they're going to get less cash than the face value, and then they're going to amortize the discount over the life of the bond. But you guys can worry about that if you ever decide to take accounting 341, or if, I guess you're required to take finance 344, so you can have fun with it in there. All right, so Boyer International issued $300,000 of bonds at 97. The market rate is 10%. What was the stated rate on these bonds? So again, this 300,000 is the face value, and they give us the market rate, and they want to know what the stated or the effective rate was. Now, a key thing to note here is that, or the thing that probably confuses people, is this at 97 thing. So when you open up, like Professor Pendergrass was saying, when you open up like a newspaper or something, that's how it's going to say or like state what the bonds are selling at. And that means, all the 97% means is that the cash received is going to be 97% of the face value, or in this case, the 300,000. So they're receiving less cash than the face value. And if we go back to this question, again, it's sold at a discount because the stated rate, the 10%, was less than the 12%, so they got less cash than the face value. So in this scenario, we know that they're receiving less cash than the face value because 97% of face value is going to be, less than 300,000. And so that means we know that it's selling at a discount. So we know that the relationship that exists between the market rate and the effective rate is that the effective rate has to be lower than the market rate because we're getting a discount. So that means that the answer is B. Now, if this question could have also have said the bond's at like 103, this means that they received a cash at issuance of 103% of the face value. So 103% of 300,000 is obviously more than 300,000. So they're getting more than the face value. So that means it would sell at a premium, and then it would be greater than 10%. So understand that relationship. Which one of the following will result from receiving cash upon issuing long-term debt? So the way I would suggest doing this problem is to kind of like write out the T-charts or like the accounting equation. So assets equals liabilities plus shareholders' equity. And what's happening here? Well, we're receiving cash and we're issuing long-term debt, which is kind of the whole point of chapters 10 and 11. So we know that our cash is going up because cash is an asset and long-term debt is going up. And that's a liability. So let's look at number D, decrease in assets. So obviously looking at our T, or our accounting equation, that's obviously not right. So let's cross off D. Increase in retained earnings. Well, remember, retained earnings is part of shareholders' equity. Nothing's happening to shareholders' equity, so that obviously isn't correct. Decrease in the company's current ratio. So during the exam, you'll have your financial ratios with you, so you'll know that the current ratio is current assets divided by current liabilities. And they want to know if it's decreasing. Well, cash is going up, so the numerator is going up. And the current liabilities, well, this is long term, so this is no change. It looks like it's going down, or a negative sign. Just remember that that current liabilities, nothing's going on. So actually the current ratio is going up. So I mean, through the process of elimination, we now know that the answer is A. But let's look at why. So the company's debt equity ratio, I don't know off the top of my head, but I'm pretty sure it's total liabilities divided by total shareholders equity. And total liabilities are indeed going up, and nothing's happening to shareholders' equity. So that would indeed increase the company's debt equity ratio. So those are just kind of like the basic questions I would look at when discussing Chapter 11. And just really make sure you understand the whole discount premium par value thing. And you should be good to go on Chapter 11. Another thing I would know is carrying value of the bond payable. So at the issuance, like let's look at this problem. So at issuance, where the company that's issuing the bond is gonna have a carrying value for the bond payable at how much cash they received. I'm just going to talk about this really quickly because I saw a question in your Chapter 11 handout, so I think it might be fair game on the exam. So, like in this scenario, at 100, so let's use this 103% number. So that means it's a premium. So we would take 300,000 times 1.03. So I'll write this down quick so you know what I'm doing. You get 106,090. That seems, nope, that's not right. Put the wrong number in my calculator. All right, so what you should get out of this is that this number is going to be greater than 300,000, and that's a number, whatever you get here, that's a number that's going to go on the financial statements as the carrying value of the bond, not the face value. Whatever 1.03 times 300,000, that's carrying value of the bond. And you also have you have the bond payable at face, and then you'll have a premium which is greater than the 300,000. And together, you net those and you get